For more than a century, we were told a simple story. Banks take deposits, banks make loans, banks fuel the economy. This story was taught in classrooms, printed in textbooks, and repeated by policymakers as if it were a natural law. But today, that story is no longer true, because the most powerful financial system on earth is no longer made of banks. It doesn't have branches, it doesn't take deposits, it doesn't answer to voters, and yet, it controls more credit, more risk, and more leverage than the global banking system ever did. Most people have never heard of it, not because it is secret, but because it was never meant to be seen. This is the story of the system that replaced banks. The old promise of banking. To understand what replaced banks, we need to understand what banks were supposed to be. Traditionally, banks played a simple role. They took money from savers, they lent that money to borrowers, and they earned the difference. This model made banks slow, it made them cautious, and most importantly, it tied risk to responsibility. If a bank made bad loans, it failed. For decades, this system worked well enough, but it had a problem. Banks were limited, they were regulated, they were capital constrained, and after the Great Depression they were watched carefully. As economies grew larger and more complex, the financial world began to feel something dangerous. Constraint and finance by its nature always looks for ways around constraints. The first escape, the escape began quietly. In the late 20th century, large institutions discovered something powerful. They didn't need banks to create credit. They could replicate banking functions without being banks. Instead of deposits, they used short-term funding. Instead of loans, they used securities. Instead of regulation, they used complexity. This new system didn't break the rules. It simply stepped outside them. Economists gave it a harmless name. They called it shadow banking, but there was nothing shadowy about its ambition. How the new system works: the shadow system does not look like a bank. It looks like money market funds, hedge funds, investment funds, private equity, insurance pools, structured finance vehicles, repo markets, securitization pipelines. Each piece appears isolated. Together they perform the same function banks once did. They create credit, multiply leverage, transform risk, and move money at extraordinary speed. But unlike banks, they do this without deposit insurance, capital requirements, public accountability. This is not accidental. It is structural. The repo heartbeat at the center of this system is something few people understand: the repo market. Repos are short-term loans, often overnight, secured by collateral. In theory, they are safe. In reality, they are the heartbeat of modern finance. Trillions of dollars move through repo markets every single day. If repo funding stops, the system freezes. In 2008, it almost did. Not because banks failed first, but because shadow liquidity vanished. That moment should have ended the experiment. Instead, it accelerated it. 2008 was not a banking crisis. The story most people remember is simple. Greedy banks made bad loans. The system collapsed. Governments stepped in. But this story isn't complete. The real collapse happened outside traditional banks. Mortgage loans were not just held by banks. They were sliced, packaged, leveraged, sold, reinsured, and rehypothecated. By the time the system cracked, no one knew where the risk lived. That was the revelation. Not that banks failed, but that banks were no longer the system. The bailout that changed everything after 2008. Something extraordinary happened. Governments did not dismantle the shadow system. They backstopped it. Central banks flooded markets with liquidity. Repo markets were stabilized. Asset prices were protected. But regulation focused mainly on banks. The system that caused the panic was allowed to grow as long as it stayed outside public view. From that moment on, finance learned a new rule. If you are systemically important, you will be rescued even if no one admits you exist. The rise of private credit as banks became more regulated. Another force surged forward. Private credit. Instead of bank loans, companies turned to private funds, direct lenders, institutional capital. These lenders face fewer restrictions. They report less transparently, and they price risk internally. Private credit exploded, not because it was safer, but because it was freer. Today, private credit rivals traditional banking in scale, yet operates almost entirely outside public oversight. This is not an accident. This is replacement. Why this system is so powerful? The new system has 3 advantages over banks. First, speed. It moves faster than regulation. Second, complexity. Risk is spread until it becomes invisible. Third, distance. Losses are socialized. Gains are privatized. Banks once failed loudly. This system fails silently until it doesn't. Why governments depend on it? Governments now rely on this system. It buys their debt. It stabilizes markets. It keeps asset prices elevated. Without it, pension funds suffer, markets cease, confidence evaporates. So the system is protected. Not officially, but structurally. And that creates a dangerous truth. When risk has no home in traditional banking, risk had a balance sheet. Today, risk is distributed across funds, instruments, jurisdictions, time. No single failure looks catastrophic until many small failures align. That is how modern crises begin. Not with collapse, but with evaporation. Liquidity disappears, trust retreats, and suddenly, nothing trades. The illusion of stability from the outside. Everything looks calm. Markets function. Credit flows. Prices rise. But this calm depends on continuous confidence. The system cannot pause, it cannot slow, it must expand or destabilize. That is the paradox. The safer it appears, the more fragile it becomes. Why this system can't go back? Some believe we can return to normal banking, but there is no return. This system exists because modern economies demand endless liquidity, constant credit, rising asset values. Banks alone cannot deliver this. So the system evolved. Not because it was planned, but because it was necessary. The real risk, the greatest risk, is not collapse. It is misunderstanding. People still blame banks, they still debate interest rates, they still argue policy, but the true engine runs elsewhere. Out of sight, across institutions, across borders, and when the next disruption arrives, it will not announce itself as a banking crisis. It will appear as something else. The system that replaced banks is not evil, it is efficient, it is adaptive, and it is deeply fragile. Because it depends on one thing above all else: confidence. And confidence once lost does not return on command. Banks once anchored the system, now nothing does. And that changes everything. In the next episode, we'll ask a question even more uncomfortable. If banks no longer control money, then who does?